I'm Spencer Carenti with Alkaline Advisors, and we are about to go through our multifamily development financial model template. So, this is our premium multifamily development template, and it's structured very similarly to our other templates. We try to keep everything concise in case you have different projects that you're working on and you want to use our models for all of your projects. So, we try to keep it very similar. But these are all fully dynamic models, and you'll notice that the tabs down here, these blue tabs are input tabs. Similarly to the model, you'll see blue cells. Those are input cells. That's where you plug your assumptions in. Everything else will auto-populate. So I'm going to give a pretty brief and broad overview of the model, just to kind of show the features and functionalities that we're offering in this model. And then we can have a deeper dive if people want to learn more or have specific questions. We're always available, so just reach out whenever. So to start, we're on the Inputs tab. As the name would suggest, this is where, let's say, 95% of the inputs are housed. So you'll see you've got return metrics up top for the project level without debt, unlevered, levered with debt, and then the partnership returns level. So this is the GP returns and the LP returns, and we'll get into that later on in the model. So under this general project input section, you'll see we've got general assumptions or general info on the project just loaded up. It's more illustrative. And then to the right, we've got project timing. When is the project starting? When are you selling the asset? Based on when you're selling the asset, you can choose the value at sale, more or less, right? So you can't choose that it is valued at 240 million, but you can choose the cap rate that we're using, and you can choose how we are deriving that 240 million based on what NOI. So are we taking the forward 12 months NOI, the trailing 12 months NOI, the trailing 3 months NOI, and then annualizing that? Essentially, forward 12 is the year after we sell, trailing 12 is the year prior to selling, and then trailing 3 is the 3 months prior, and then you just multiply that by 4 to annualize it. And that's how you'll derive the value. So you could be a little flexible there. Underneath that, we've got the rent roll section. So this is where you'll load in all of your units or your unit mixes. Because this is a development project, you don't necessarily know exactly when each unit is going to lease up. So you can just be general with it as it relates to the unit mixes, the unit types. So you can choose how many units of each unit type you have, the size, the untrended dollar per unit per month amount, and then the lease up start month, how many units are pre-leased, and then how many units are leased per month thereafter. So once pre-lease or once the units come online, the pre-leased units come online. Underneath that, we've got an other income section. So you can choose what other income you have. Is it tied to the units as they come online, or is it tied to the building as it's delivered? Then you can choose how you are paying, right? Is it, or how you're receiving capital if this is, or revenues if this is other income. Is it dollar per unit per month or total dollar per year? Similarly with expenses, broken out the same way. You can just toggle and update accordingly. Same thing with management fee. You can toggle between total rental income or just total income, which is inclusive of the other income. Over here, you'll see rent growth and loss. Plug in your rent growth, loss to lease, vacancy, concessions, other rent loss. And then this will update automatically depending on what your other inputs and assumptions say, right? So depending on when does construction end, depending on when lease up starts and stabilization occurs, these will update automatically. This tax section, without diving too far into it, we've given you a couple different ways to illustrate taxes. One, you can just dump in the amount on a per year basis, and then year 6 would be growing at that year 5. It'd be starting at year 5 figure, growing at a percentage thereafter every year. And I think it's growing at a monthly level. So it's not every 12 months we elevate or we escalate by 3%, but that 3% is annualized essentially. So then we have a goal seek way of doing it. And again, without getting too far in depth, and we outline the instructions of how to do this, and we can answer any questions later. But see, if you need the instructions, it'll tell you how to do it. We're using what if analysis, goal seeks to back into the stabilized value and the sale value to essentially factor in what the taxable amount would be at stabilization and sale, given that we are using 1.1% or whatever percentage you want of stabilization and of sale to figure out that taxable amount. And it's a little wonky. We don't have circular references in this model, so this isn't circular. This is a way that we do it to get around the circularity, so to speak. And I'm just being very high level. We can dive much, much deeper into how we do it, why it works the way it does, and ways that you can incorporate it. So underneath this, we have the financing section. Financing section gives you a lot of functionality. We have a construction loan segment and then a pref equity segment. If you don't have preferred equity, or this could also be used really as mezz debt, up to you. And pref equity, this is different from LP equity. That we'll talk about in the partnership return section. But you can toggle it on and off, right? So if you do have it, you'll toggle it on. We'll get to that in a second. Just in terms of how the capital stack is, how we're deploying capital in the capital stack, we first run through common equity. So that'll be GP and LP equity simultaneously, right? It's pari passu. And then we will have, we will deploy pref equity, and then we will deploy the construction loan. So for the construction loan, in order to, let's actually jump down here first. This is where you load in the costs, which depending on what loan to cost percentage you want, will drive the loan amount. So here you load in whatever you want in terms of the labels and then the amounts, and you can choose if the segment is financeable or non-financeable. So we're saying land acquisition is non-financeable, soft cost and hard cost is financeable. These are phantom numbers, general numbers right now, so we didn't get in depth with the breakouts. So here you can choose what the loan to cost is. Now as I said, we don't have any circular references. We don't have any macros. We are calculating the interest reserve in this loan to cost amount, loan to cost with interest reserve. And to do that, all we do, it's very straightforward. We go to the what if analysis up here. So data, what if analysis, you go to goal seek, you'll say set this cell equal to whatever the loan to cost percentage you would like, inclusive of the interest reserve to be. So let's say we want it to be 62%. We'll do that by changing the input cell, that blue cell. We click OK, it'll iterate, and it'll get us close enough. And we can run it a few different times to be a little more accurate. But essentially it's saying now our loan to cost with interest reserve is 61.97%, which is, let's say, 62% like we wanted. And to double check that too, you can take your debt with interest reserve. So it would be this figure, and you would take the total financeable costs with interest reserve figure. And there's your 61.97% amount. So you can also choose what the loan fee is. The way that the model works now is it provides some flexibility. You'll see, you've already seen we have some good toggles. But essentially, for this construction loan portion, what could happen is you might be generating some revenues before you pay off your construction loan, right? Let's say you're not fully stabilized, you're 60% stabilized or 60% occupied, and you are now generating some revenue. Well, ultimately, you can put that revenue in your pocket, or you can reallocate it to pay down what would be the accruing interest for the construction loan. So that's what we allow you to do here. You can toggle whether or not you want the cash flows to pay off the interest that would ordinarily be accruing if you didn't have the money to pay it current. So you can say no, and then you'll have to, depending on how long the loan is in place for, you'll have to carry that cost, the accruing interest, until you pay down that loan, or you could say yes, and you're just accruing interest until you have enough cash to pay down the interest current. So underneath, you can choose the loan type, and I'll show you where this is in a second. You can choose the loan type, fixed or floating. If it's fixed, it's pretty straightforward. If it's floating, we have it tied to SOFR. You choose the points over SOFR, the floor, the ceiling, and then you paste SOFR down here based on the SOFR curve. We pull this from Chatham Financial. So with the pref equity section, you could say you want it, how much pref equity you'd like. Then you choose what the upfront fees are, exit fees. Is there any current pay? What's the accrued pay? What percent cash are you sweeping when you have free cash flow to pay down the pref equity? And then ultimately, is there a minimum equity multiple, and what does that look like? So if we say that there isn't a minimum equity multiple, then it is what it is at the time you can pay it down. If there is a minimum equity multiple, you'll pay it down based on that total time period or based on what that minimum equity multiple is and when you can hit that with the amount of cash available in a given time period. Next, we have sensitivities. So this is a 2-variable sensitivity analysis. We're sensitizing sale month and exit cap. What we've done here is given you the opportunity to see what's sensitized. Before we dive into that, you'll see this yellow pops up with red. It says, note if return cell, this is the return cell, is red, update table. So go to formulas and just click calculate now. So we'll go to formulas, we'll click calculate now. It takes a second, but it will update. And the reason for that, there we go. The reason that happens is because we run our models in automatic except for data tables. We do that because if it was automatic, every time we make an update, the sensitivity analysis would iterate and it would cause the model to work extremely slowly. So whenever you want to refresh a sensitivity analysis, you'll just have to click that. Now, what's also really cool about this is right now you're seeing how the profit at a levered project level, so the profit with debt, is impacted if you sell the asset in month 114 versus month 126 at a 5.5 cap versus a 6.5 cap and everything in between. What we can also solve for is IRR and equity multiple, but not just on a project level, but on a GP level and an LP level. So you can select what it is you'd like, right? You've got the red cell again, you click calculate now, and boom, here you go. This is the sensitivity. So we think that's a pretty nifty feature. So now I'll go a little quicker through the rest of the model. This is the cash flow tab. So this is a monthly model. You'll see it's separated into different sections. You'll have the construction cost section up top, operating section down here. Then we have the capital section, right? First we have the equity, then the pref equity, and then the construction loan. Underneath we have the perm debt. And then underneath that, we have the sale value. That'll boil into the contributions and distributions, which we separate out. So you can see what you need to bring to the table on a project level, what you need to cover an operating shortfall, and then ultimately what distributions you're getting from operations, and then what distributions you're getting from a capital event like refi or disposition. Before we go any further, I totally forgot. I'm so sorry. We're going to go back to the inputs tab for a quick second, talk about the perm loan. So what we're going to do is, if we have a refinance, you turn this to yes, and then here are your assumptions. You can choose what the loan to value is, and you can choose what the minimum debt service coverage ratio is, the minimum debt yield is. So we're sizing the loan, and we're going to ultimately see if we have enough firepower from our refi to take out our construction loan. So what we do here is we'll say, right, we want 60% loan TV, minimum DSCR 1.1, minimum debt yield of 5%. How are we valuing the asset? Well, we want to value it based on a cap rate, but you can choose dollar per square foot, dollar per unit. So we want a 5.5% cap rate at month 33, which is when we say we're refinancing. You'll see that we stabilize in month 33, so that's a good bet. But you can choose what NOI we're using. Again, are we taking the trailing 3 months NOI, the in-place NOI, annualizing that, so multiplying it by 12, or taking the forward 12 months NOI? And ultimately, that'll tell you what the loan to value is, which is right here. So if you want a 70% loan to value, we put 70% there. You'll see this actually shines yellow. Why? Because we have a minimum debt service coverage ratio of 1.1. And based on the loan amount we are trying to secure, the max LTV we can hit is 65.8%. So you want 70, but the most you can get is 65.8. So we size it for you. And then we have the interest rate, amortization period, interest only, right? Same thing with the debt yield. Right now we're at an 8.36% debt yield. If we want a 9% debt yield, well, now we're at a 9% debt yield, 1.18 minimum DSCR, and our actual LTV is 61%. So it's, again, another nifty feature. All right, jumping back to the cash flow section. So here, there are very few inputs. The only inputs are up at the very top, and the only inputs are going to be in the cost section. So you'll notice when you plug in your construction costs, they will auto-populate on the inputs tab. They will auto-populate here. You can choose when the costs start and when they end. So, how are they being allocated throughout the construction period? Are they going to be straight lined? Is there going to be some sort of bell curve? Or we can build out custom cash flows as well. So you'll determine how the capital from a cost perspective is allocated. And that ultimately will drive when we need to bring our equity to the table, when we need to draw debt, and so on and so forth. So it's all interconnected. Then we have the operating statement, and you'll see right here we have a snapshot on a dollar per unit per month level and a annual level. This is showing essentially a snapshot untrended versus stabilization. Untrended is just with assuming there's no growth, and the project were to come on today, what would rents be and expenses and so on and so forth based on costs. So you have untrended, you have then trended at stabilization, and then trended at sale. And you can compare them all to each other. And then you have it on a dollar per unit per month basis as well. So you have the operating statement. If we expand this out, you can see this is the unit matrix, lease up schedule. When do they come online? You can expand this out. This is actually when the dollars are coming online for each unit. So I will minimize that again, minimize this again. But what you'll see is we have the lease up schedule. You can see what percent total lease we are given the market. And then ultimately what percent we are leased based on physical occupancy and then based on economic occupancy. So that's kind of where the loss to lease, vacancy, concessions, other rent loss are factored in. So you can see what are you actually making based on all the units that you could potentially be making money on. So other income, it's here. You can get a further breakout by clicking that button. And then same thing with expenses. If you have additional expenses, you would just show them all. But you could see they're growing on a monthly basis based on your annual growth rate. And that all flows down to the NOI, which you'll see right here. So jumping to the capital stack section, as I said before, first we're deploying equity, then we're deploying pref equity, and then finally we are deploying the construction loan. Now you'll see the $7.2 million fee, it's accruing. So you don't have to pay this current, this is just added to your principal balance for the construction loan. So you'll have to pay it off when it comes time to pay off the construction loan. And you are accruing interest on all this as well. So you'll see that you have total interest owed in any given month, right? Total interest owed, total paid by cash flows, and then ultimately the accrued interest and fees. So this, if anything's here, it'll be added into the principal balance that you need to pay down, and then you're paying interest on this. And that's kind of where that toggle comes into play. As we said before, here you'll notice now we start to have interest paid by current cash flows. So in month 24, we're almost able to cover all of the interest that would be that is owed in that period, but we don't. So we have to accrue some of it, and then the next month we're able to pay all of it current. So underneath that we have and then you'll see we have the capital available in month 33 from the refi. Here's the perm loan amount. This is the proceeds we're getting. We're paying off $65 million. We have fees of $1.1 million. So ultimately, our bottom line, we're getting $48 million in that refi proceeds in this period. So you'll see the perm debt's in play up until the sale month, and then we're saying we're selling in month 120. Here's the sale month, right? Or here's the sale section. In month 120, we're selling based on the cap rate, based on how we're pulling in the NOI. So that's the cash flow section. Next, we're going to jump into and then it boils down into the most important part, unlevered and levered cash flow. You could see what the project would make, no debt, and then what the project makes with debt, and the cash flows per period. Next, we'll hop into the partnership returns tab. This is the partnership return structure. You can choose, so GP LP splits. You can choose what percent of equity the GP brings to the table. It'll calculate the remaining percentage for the LP. You can choose how the partnership is structured. So it could be pari passu, even for dollar in, for dollar out. You could say that there's one hurdle. You could say that there are 3 hurdles, right? You choose the pref amount or the hurdle amount, and then ultimately what the promote is for the GP. We've added in some cool functionality where you can toggle between the compounding frequency. So are we compounding the pref annually, monthly, or no compounding? Distribution frequency. Are we making distributions to the LP on and GP on an annual basis, quarterly, or monthly basis? And then equity contributed. Are we saying that we're only bringing the equity to the table whenever it's needed, or are we collecting it all up front? Obviously, time value of money. If it's needed up front, you need it from the LP up front. It's going to be outstanding longer. So it'll bring down the IRR for the LP, right? If it's incurred, it'll increase, but it's negligible in this sense, just 1%, 0.5%, right? So not too much. Okay. So we have an annual cash flow. This is similar to the monthly, but it's just on an annual basis, all rolled up. We have a rent roll tab. This just gives you some more information in terms of untrended, rent roll, trended, lease up schedule, what the market rate is, and then what the total market rent is. So per unit, and then based on all of the units that we have. So just another illustrative area. You can copy and paste this into decks. And then finally, we've got our summary. So these are pretty cool. We've got investor summaries and lender summaries. The investor summary auto-populates everything, even the text, right? So right here, it says Alkaline Advisors acquires land zone for development 300 units. If we do inputs, we can change this to test 1, 2, 3. And then we go back to investor summary. Now it says test 1, 2, 3 acquires, right? So everything auto-populates. We can even customize these bullets in any way that you want them to be customized. But ultimately, you have basic description up top. You've got a snapshot at stabilization, at refi, at sale. We have untrended yield on cost, trended yield on cost, development spread, DSCR, debt yield, you name it. It's all here. You can see sources and uses. So these will equal each other, right? Metrics and returns, we have it broken down for unlevered project, levered, pref equity, LP, and GP. And if you don't want to show the GP returns, which you probably should, right? If you want to just be fully transparent with everyone, you can just toggle that to no, but we'll toggle it back to yes. Sources and uses, another cool function is we have the interest broken out a little more. So you can see what is the interest reserve, what is the loan fee that's reserved, and then what's the current interest paid during the construction period. So as construction is happening, we're saying, all right, if we're able to pay off any of that, what would have been accruing interest, that's going to be considered a construction, cost. And any interest that we're paying current post-construction, we're not including that as a construction cost. So that'll ultimately bring down the cost of the project, right? And so right now we're at 120 million versus what it would be if, and we can actually show you right now, if, for instance, we were saying that all of the interest accruing until you're paying the construction loan off is part of the project cost, we would turn this to no, and you see, well, now the total project costs 187 million, right? And we can toggle this according to whatever you'd like, whether it's until stabilization or until perm loan, you name it. So just going back there. So also in the investor summary, we have the sources and uses chart. So this will update automatically. Sources and use of graphs. These will update automatically. We have construction loan notes, perm debt notes. So right, perm debt is blank now because we had no perm debt. If we toggle this to yes, and we go back to investor summary, now you have the perm debt notes down here. Sensitivity analysis. We have market rent summary at stabilization versus at sale, depending on what you want to show. We have a stabilized month at operation snapshot versus the sale month. And here you could see based on how you wanted to analyze it or how we wanted to analyze it, but you will choose with your model. We're using the in-place NOI for stabilization annualized versus here at sale, we're taking the forward 12. And you can see how that impacts the bottom line and the difference in value at stabilization versus sale. And then we have a condensed annual summary here. So this you can just send over to the investors or just an easy way to talk through things with people. What is also cool about the whole model, but even this, especially this section, you just print it and it'll pop up nice and easy in PDF format. You just save it and send it out. And then finally, we have a lender summary. I won't dive too far into this. Very similar, but here it'll just show the debt request. All this stuff will auto-populate. You can just send this to the lender, talk it through with the lender. And then if they want to be involved in the refi, we have a refi snapshot that they can see sources and uses and kind of everything's just outlined here. We don't go as deep in depth into the equity, right? So here we just have the equity, which I actually think we have to change this color, funny enough, because that's not yellow, that's orange. But everything else should be good. Yeah, so here LP equity, we break it down, is orange, GP equity is purple, that sliver. Pref equity is purple, which is that sliver. GP equity is gray, which is that gray. And then we don't have much cash from operations. We only have 31,000, which in the grand scheme of things, 120 million, you can't see here. So that is our multifamily development model. And then we have our disclaimer. You have to keep this in. If you take it out, the model will explode. If you have any questions, reach out. We love walking people through this. We think it's a really awesome tool. It does really amazing work. And we can customize this however you'd like it to be customized. That's the coolest part of all this. Yes, this is a base template, but we can build models from scratch, or we can just provide the base template as is and answer questions. But we can be as involved or uninvolved. And if you have any questions, please always feel free to reach out. Again, Spencer Carenti from Alkaline Advisors, and I am signing off for the evening.